Before we begin, I want to say something important. This is not going to be a normal stock market video. Over the last several days, I have personally gone through 5 full annual reports, 5 analyst calls, balance sheets, cash flow statements, P&L accounts, debt structure, ROCE analysis, geo numbers, retail expansion, renewable energy projects, AI infrastructure plans, and more. I have analyzed thousands of pages of actual financial data to create what may be one of the deepest Reliance Industries analysis available on YouTube. And this is not just one video. This is a complete 5-part deep dive series. In this series, I will reveal hidden red flags, full growth potential, exact financial ratios, promoter analysis, debt risks, AI opportunities, renewable energy gamble, geo monetization, retail economics, and whether Reliance can become one of the world's most powerful companies over the next decade. Everything with actual figures and numbers. No hype, no blind bullishness, no fear mongering, only deep analysis. So, if you genuinely enjoy detailed investing and long term wealth creation content, make sure you watch this video completely till the end. And one more thing, part 2 is even more powerful than this episode. In part 2, I will reveal the real balance sheet strength, hidden debt risks, cash flow quality, 6.9 lakh crore rupees capex analysis, free cash flow truth, and the bigger financial red flags hidden inside Reliance. But I will upload part 2 only if this video crosses 100 likes. So if you want the next part, like this video, comment below, share this with serious investors, and subscribe to the channel. The more support this series gets, the faster I will release the next part. Now let's begin the deepest Reliance Industries analysis on YouTube. When most people look at Reliance Industries, they think of one thing: oil, refineries, petrol pumps, and maybe telecom because of Geo. But after going through 5 years of annual reports, balance sheets, cash flow statements, and 5 complete analyst calls, I realized something much bigger is happening. Reliance is no longer trying to become India's largest company. Reliance is trying to become India's infrastructure backbone. And in this series, I'm going to break down the numbers behind that transformation. Not motivation, not hype, actual figures, actual annual report numbers, actual management commentary, actual risks. And in today's first part, I want to answer one question. How did Reliance go from a refinery company into a 11.76 lakh crore rupees revenue ecosystem? Because the transformation is much bigger than people realize. And it starts with the numbers. Let me first show you how absurd the scale of Reliance has become. In fiscal year 21-22, revenue was 7,88,743 crore rupees. By FY 25-26, revenue became 11,75,919 crore rupees. That means Reliance added nearly 3.87 lakh crore rupees additional annual revenue in just 5 years. To understand how insane that is, many entire Indian companies are not worth 3 lakh crore rupees. Reliance added more than that in annual revenue alone. Now here is what becomes even more important. EBITDA, EBITDA, because revenue can grow without profitability, but EBITDA tells you operational strength. In fiscal year 21-22, EBITDA was 1,23,684 crores. By FY 25-26, EBITDA became 2,07,911 crore rupees. That's nearly 68% EBITDA growth. And PAT, profit after tax, increased from 66,184 crore rupees to 95,754 crore rupees. That's almost 1 lakh crore annual profit. Very few companies globally operate at this scale, and this is exactly why Reliance deserves deep analysis. Most investors still value Reliance like an oil company. But after reading all 5 calls carefully, I noticed management is actively trying to change that perception. Mukesh Ambani and management repeatedly emphasized consumer businesses, digital infrastructure, AI, retail ecosystem, media integration, renewable energy, not refining, not petrochemicals. This is critical because the valuation multiple of an oil company and a digital infrastructure ecosystem are completely different. Oil companies globally may trade at 6 to 10 PE, but digital platforms can trade at 25 to 50 PE. So, the biggest battle Reliance is fighting today is not operational, it is narrative transformation. And the numbers clearly show this transition happening. Let's talk about the crown jewel, Geo. Because after reading all the con calls, I genuinely believe the market still underestimates Geo. Here are the actual numbers. Total subscribers in fiscal year 26 is 524 million, 524 million. 5G subscribers, 268 million. Home broadband connections, 27 million. And one of the most shocking numbers management revealed was this: 45% of Geo's data traffic is effectively free on 5G. Think about that carefully. That means almost half the traffic is not yet fully monetized. Now let's look at the ARPU, average revenue per user. Fiscal year 25, quarter 4, 181.7 rupees. Fiscal year 26, quarter 4, 206.2 rupees. What is the increase? 13.5%. Now this is where operating leverage becomes extraordinary, because with 524 million users, even a 10 rupee ARPU increase creates roughly 6,288 crore rupees annualized revenue increase just from pricing. No major subscriber growth required. This is why telecom business becomes extremely powerful at scale. Now let's go deeper. Jio EBITDA margins reached 52 to 53%. That is an elite global telecom profitability. Many telecom operators globally struggle to maintain 30 to 40%. Jio is already above 50%. And that is why, while management still says monetization remains early, this tells me something important. Jio is no longer only a telecom company, it is becoming a digital infrastructure platform. And management's commentary repeatedly hinted at this direction. AI infrastructure, cloud, enterprise solutions, air fiber, data ecosystems, digital commerce integration. This is much bigger than SIM cards. Historically, Reliance profits were cyclical, dependent on oil prices, refining margins, petrochemical spreads. That creates unstable earnings. But telecom changes that. Why? Because telecom produces recurring cash flows, monthly recharges, subscriptions, broadband payments, enterprise connectivity. That stabilizes earnings. And you can already see this happening in the EBITDA profile. Earlier, oil to chemicals, O2C, dominated profits. Now, consumer businesses contribute a much larger percentage of EBITDA growth. This transition is one of the most important developments in Reliance history, because recurring cash flow businesses receive better market valuations. Now let's talk about what may actually become Reliance's largest business eventually, which is retail. Most people still underestimate Reliance Retail because margins look lower today, but the scale is unbelievable. FY26 retail revenue was approximately 3.6 lakh crore rupees. EBITDA was 24,200 crore rupees. Store networks were 19,000 plus stores. Registered customer base was 349 million. Now think about that. 349 million registered customers. That's larger than the population of many countries. And management's strategy became very clear across the con calls. They are building physical stores, digital commerce, quick commerce, hyperlocal logistics, FMCG brands, supply chains, all integrated together. This is ecosystem building, not normal retail expansion. This is where things become interesting. Management disclosed 1.6 million daily order run rate in quick commerce. Now the market gets excited seeing growth, but I look at profitability. Globally, quick commerce businesses often struggle. Margins are thin, sometimes negative. The problem is delivery infrastructure is expensive, warehousing is expensive, customer acquisition is expensive, and discount wars destroy profitability. Now, here is what concerns me. Reliance Concalls discussed scale aggressively, but they gave limited detailed margin guidance for quick commerce. This itself is important because it suggests the profitability model is still evolving. So while this segment can become huge, investors should understand growth does not automatically equal return. One of the most underrated developments from the Concalls was FMCG. Management repeatedly discussed Campa-Cola expansion, distribution scaling, regional market share gains. In some territories, management claimed around 14% market share. Now, here is why this matters. Reliance already owns retail distribution, logistics, warehousing, consumer data, telecom ecosystem. This creates a powerful distribution advantage. Imagine launching FMCG products with 349 million retail consumers plus 524 million telecom users. That distribution power is enormous, but again, there are risks. FMCG giants, FMCG giants like Hindustan Unilever, Nestle, ITC, they operate at around 20 to 35% EBITDA margins. Reliance is nowhere near that yet. So execution remains critical. Now, let me show you the biggest transformation visible in the financial statement. Revenue from 7.89 lakh crores to 11.76 lakh crore rupees. EBITDA from 1.24 lakh crore rupees to 2.08 lakh crores. Cash profit from 1.11 lakh crore rupees to 1.71 lakh crore rupees. This last figure is extremely important. Cash profit, because accounting profits can sometimes be manipulated through accounting adjustments. Cash flow is harder to fake, and Reliance generating 1.71 lakh crore annual cash profits means the business has enormous internal financial strength. This cash funded 5G rollout, retail expansion, AI infrastructure, renewable energy projects, battery manufacturing, solar ecosystems without severe balance sheet stress. This is extremely important. Now let's address the concerns most people raise about debt. Gross debt increased from 2.66 lakh crore rupees to 3.74 lakh crore rupees. That sounds dangerous initially, but here is the key point. Debt equity ratio remained around 0.41, meaning equity also grew significantly and cash generation improved strongly. This is productive leverage, not survival leverage. There is a massive difference. Weak companies borrow because they need money to survive. Strong companies borrow because they see high return opportunities. The real question is, will these investments generate high returns later? That is the key investment question for Reliance today. Now, let's talk about the biggest financial red flag. ROCE decline, return on capital employed. This may be the single most important long-term risk. ROCE declined from roughly 20.6% to around 11%. That's a major drop. Why? Because Reliance invested nearly 6.9 lakh crore rupees in capex over 5 years. This is a massive expansion, but those new businesses are still maturing. This means capital deployed today is not yet producing full returns. Now, this is normal during aggressive expansion phases. But if the future businesses fail to produce 12 to 15% plus ROCE eventually, then shareholder returns may disappoint. This is the key risk sophisticated institutional investors are watching. One fascinating pattern in the Concalls was the increasing mention of AI infrastructure, not just telecom, AI infrastructure. This tells me Reliance wants to position Geo as India's digital backbone. Data centers, cloud infrastructure, AI compute, enterprise digital ecosystems. This could become extremely valuable over the next decade. But once again, monetization remains uncertain. Management gave strategic vision but limited concrete revenue guidance. That means the opportunity is real, but financial visibility remains low. After studying everything carefully, I think the market still misunderstands Reliance. This company is no longer optimizing for short term quarterly profits. It is optimizing for ecosystem dominance. That is telecom, retail, media, commerce, cloud, AI, renewables, FMCG. Integrated together, this is platform economics. And platform businesses become extraordinarily powerful if executed correctly. But they also become extraordinarily complex. That complexity itself becomes a risk. So after reading all 5 annual reports and all 5 con calls, here is my conclusion. Reliance is attempting one of the biggest corporate transformations globally, from a cyclical hydrocarbon company to a digital consumer energy infrastructure platform. The upside potential is enormous, but so is the execution risk. The next 5 years will determine whether Reliance becomes India's dominant platform supermajor or an over-diversified, capital-intensive conglomerate with declining returns on capital. And in part 2, I'm going to go even deeper into the balance sheet, cash flow statement, capital allocation, renewable energy strategy, and the hidden risk most investors completely ignore. Because once you start studying the numbers deeply, you realize Reliance is not just building businesses, it is trying to build national scale infrastructure ecosystem, and that changes everything. So, after studying Reliance Industries deeply through annual reports, cash flow statements, balance sheets, financial ratios, and analyst con calls, one thing becomes very clear. Reliance is no longer just an oil company. It is trying to become India's largest integrated digital consumer energy infrastructure ecosystem. And honestly, the scale of ambition is extraordinary, but the risks are also enormous. Because the next decade will decide whether Reliance becomes one of the world's defining platform companies or an over-expanded conglomerate struggling with capital efficiency. And in part 2, we will break down the complete balance sheet, debt structure, cash flow statement, free cash flow, hidden liabilities, working capital pressure, ROCE decline, and the biggest financial red flags most investors completely ignore, with exact figures and actual annual report numbers. So, if you want part 2, make sure this video crosses 100 likes, and don't just like the video, comment below and tell me, do you think Reliance can become a global platform giant over the next 10 years? And also, share this video with investors, subscribe to the channel, and turn on the notifications, because this is going to become one of the deepest financial analysis series on YouTube. Thank you for watching. I'll see you in part 2.